Hi friends, this is Ravi Kanth Miriyala. Right, my classes on CA final paper number 1 financial reporting are available on Unacademy platform. Yeah, these are recorded as well as live, and it is 100% comprehensive and 100% English batch, wherein we discussed each and every concept of Ind AS, which will be useful to the students even after qualification for practice purpose. Also, this will be useful. Yeah, please, inform your friends about this information. And on an academy platform, comprehensive batch on GFRS also is done. 23 classes, 69 hours, entire ICA material with PY examination questions and mock test papers also are covered in this discussion. It will be very much useful for CA final GFR, that is paper number 6E. Next, for my books, that is on Ind AS made easy, our financial reporting made easy, and fast track summary book. Yes, you can order in ravikantmiriyala.com, or you can contact the given number for the books. Right, for your doubts, clarification, please join the Telegram group Ind AS discussion group RKM. These charts are from my book Quick Revision Fast Track Charts on Financial Reporting. Yeah, which is available from my website, that is ravikantmiriyala.com, as well as it is available in the market. Let us look at Ind AS 12, that is income taxes, a beautiful standard. See, we will follow, in accounting standard 22 we must have followed profit and loss approach, but here we will be following balance sheet approach. Yeah, we will not look at whether it is allowed by the allowed for the purpose of tax or what is recognized in the profit and loss. No, we will see the balance sheet. Balance sheet and asset and liabilities will be the basis. Yeah, this is basically to ensure a matching concept. Matching concept in the sense current year income is supposed to be taxed in the current year. That is the basic concept. Right, here few definitions. One is accounting profit. Accounting profit in the sense profit as per the profit and loss statement. Taxable profit means PBT, then plus or minus whatever your adjustments you will do it, then that is the taxable profit as per the Income Tax Act. Then tax expenditure includes current tax as well as deferred tax. Current tax in the sense tax payable as per the Income Tax Act. When you make an advance payment, then advance tax account debit to cash. When that will be happening all the 4 quarters. Then next, when at the end of the year you should make a provision for a tax, then that is the current tax expense account debit to provision for a tax. We will be maintaining both the accounts. One is advance tax account, at the same time provision for a tax. We will be presentation will be happening in net off. Yeah, we will see advance tax 1000 rupees, provision for a tax 900 rupees, then net will be advance tax 100 rupees will be presented. Yeah, when it is settled by, that is assessing officer completes the assessment, that day provision for tax account debit to advance tax. If there is any refund amount or if there is any payable amount, we will record it accordingly. Yeah, that is about current tax information. And when it comes to deferred tax is something which is created from the standard. Right, what is deferred tax? Deferred tax is temporary difference into tax rate. That's it. What is temporary difference? Temporary difference in the sense carrying amount as per the books of account minus tax base. That is what temporary difference. Our temporary difference into tax percentage, if you apply, then you will get deferred tax. That deferred tax can be deferred tax asset or deferred tax liability. But before that, temporary difference can be taxable temporary difference or deductible temporary difference. If it is taxable in the sense payable in the sense deferred tax liability will come. And deductible temporary difference means it is beneficial. Correct. Deductible means it is going to reduce my income tax liability in the future. So deductible temporary difference will create deferred tax asset. Yeah, when that deductible taxable we'll see little later, but first let us spend good amount of time on the tax base, which is very important. Right, tax base, when I say tax base is for the tax, one second. Yeah, tax base is for asset, tax base of liability. When I say tax base of asset, yeah, before we say tax base of asset, first from the economic benefits which are derived from the asset, are these taxable? In the sense, by using the machine I'll generate some goods, or goods I will sell it, whether that sales are taxable, or if I sell the machine itself and I will get some money, is that taxable? That is what question. If you say that economic benefits arising from the machine either by usage or by the sale, is it taxable? If you say taxable, then how much amount will be deductible from the taxable income? Taxable income is something minus what is the amount which will be deducted before you recognize the taxable income. That will be my tax base. If you say no, it is not taxable, these are not taxable, under that circumstance tax base is equal to carrying amount. That's all, right? With respect to liability, tax base of liability, tax base of liability, first we should ask what kind of liability. Liability, is it advance income? Yeah, some income is received in advance. Then other liabilities, all other liabilities will be treated, the tax base calculation will be different, advance income calculation will be different. Okay, with respect to advance income, I mean that is a liability, what is the tax base? Then what do we see? Carrying amount minus the revenue which will not be taxable in the future. Revenue which will not be taxable in the future. I mean, you should calculate, like 100 is the income, how much will be taxable you tell in the future, then 100 minus taxable will be which is not taxable in the future. Like that you can calculate it, right? In case of other liabilities, carrying amount minus what will be allowed, on payment, allowed on settlement, deductible on settlement, that difference amount is what going to be tax base. That is the, right, I repeat once again, tax base for an asset is based on the question is, the economic benefits which are going to be generated from the asset, means money will come from the asset, money will come from by selling the goods generated from the asset or by selling the asset itself. Is it taxable? If you say taxable, the amount what will be deductible in the future, deductible in the future taxable income, that is from the taxable income, that is the tax base. If you say the future economic benefits are not taxable, you don't account it for the purpose of taxable income, under that circumstance tax base is equal to carrying amount. Tax base of liability, yeah, it is divided into, is it any income received in advance, other liabilities, income received in advance, with respect to that tax base is equal to carrying amount minus the revenue which will not be taxable in the future, that is tax base. And with respect to with respect to other liability, carrying amount minus the amount that will be deductible on payment, right? With respect to few assets, like example, preliminary expenses must have been already charged to profit and loss as per your Ind AS 38 intangible assets, right? There will not be any carrying amount, but there can be a tax base, because as per the income tax, that will be allowed as a deduction over a 5 years period, hence it is going to be our, right, there will be tax base even though there is no carrying amount, right? Let us spend some more time with respect to temporary difference. Temporary difference, as I told, taxable temporary difference, deductible temporary difference. With respect to taxable difference, we have to create deferred tax liability for all the taxable temporary difference. Will create temporary difference ko you will create the deferred tax liability. There is no, there is no exclusion, but there are some exceptions are there, right? With respect to deductible temporary difference, what do? We will create deferred tax asset. First we will say it is for all, but we will say one small point, only when, yeah, we will create deferred tax asset only when it is probable that there will be taxable income, taxable profit in the future. Because if there is a taxable profit in the future, then this deferred tax asset can be offset, otherwise it is useless. So if you ensure that there is a reasonable certainty that there will be taxable income in the future, then yes, you create deferred tax asset. But still there will be some more exceptions. What is the exceptions are? With respect to deferred tax liability, there are two exceptions, right? Under these two circumstances, it is prohibited. You are not supposed to create deferred tax liability. One, goodwill which is arising from the business combination. Yeah, goodwill arising from the business combination. Goodwill carrying amount is there in the books of account, right? But as per the tax records, that nothing will be allowed right? This is goodwill, initial goodwill, not subsequent goodwill. Initial recognition of goodwill accounting as per the business combination, no. On that recognizing what? recognizing that deferred tax liability is prohibited. And the second thing, it is initial recognition of asset or initial recognition of liability which is arising as not as part of the business combination. You are getting an asset not under the business combination, but this at the initial recognition itself, it is affecting neither accounting nor taxable income. I mean, it is not considered for the tax purpose, also not considered as an income for the accounting purpose. Under that circumstance, right, suppose government has given you some grant, something has given you at free of cost. Yes, by using that asset, I mean, in the future, I mean, it is not taxable for the tax purpose. At initial recognition, we will be recognizing in the balance sheet, we will not transferring it to profit and loss even. Under that circumstance, right, you are not supposed to, I mean, you are not supposed to create deferred tax liability for those assets in the initial recognition. With respect to goodwill, I have one more point to say, right. With goodwill, right now at the initial recognition of goodwill, you are not supposed to create, that is prohibited. But so subsequently, can I create it? Subsequently, if the goodwill is allowed for the amortization as per the Income Tax Act, if the goodwill is allowed for the amortization as per the income tax, yes, then subsequently you can create deferred tax liability. You can create deferred tax liability, yes, as allowed. Okay, right, you can create deferred tax liability subsequently, that is on the subsequent balance sheet date, not on the date of acquisition. Next, the exceptions with respect to deferred tax asset. Yeah, what are the exceptions? The second point of this, that is initial recognition of any asset or liability which is not a business combination and it does not affect the accounting income or taxable income. Even in this case also, deferred tax asset is not allowed to be created. Okay, right, let us have a look at some examples which are there. Suppose development expenses as per the income tax, it will be charged immediately. That means the carrying that means there will not be any future allowance, will not be any, nothing will be there. That means tax base is equal to 0, but there will be some amount, that is carrying amount, because we will be recognizing as intangible asset under development, right? That's why it will lead to deferred tax asset, because asset is carrying amount is there, tax base is equal to nil. Correct. Now carrying amount is greater than the tax base, then asset, then it is going to be deferred tax liability. Carrying amount of the asset is lower than the tax base, then deferred tax asset. This exactly ulta will be applied for liability concept. Next, PPE measured at fair market value. I mean, PPE measured at fair market value, it is upward valuation. That means carrying amount of the asset is greater than the tax base, then automatically it leads to deferred tax liability, right? PPE measured at the fair market value which is downward, then automatically it will come to deferred tax asset, right? Next, you bought some assets in business combination and you have recognized at fair market value. Yes, right. What will be the tax base? Tax base will be the carrying amount of the acquiry carrying amount will be the tax base for me. Yeah, under that circumstance, it depends. Net assets fair market value, net assets carrying amount of the acquiry, we will compare. Accordingly, it may come to deferred tax asset or deferred tax liability. It can be anything. Next, cost of inventory is equal to 100 rupees assume, but wherein it is measured at NRV which is equal to 80 rupees. That means your carrying amount is equal to 80, but if you sell up to 100 rupees, deduction will be available. So carrying amount is what? Lower than the tax base, then automatically it leads to deferred tax asset. Next, debtors minus doubtful debts. That is the carrying amount is equal to say 90 rupees, but the tax base will be 100, because as per the Income Tax Act, up to 100 rupees collection it is allowed. Unless until it is a bad debt which is confirmed, then only deduction will be available. For the allowance for doubtful debts or provision for doubtful debts, they don't give any deduction. Then that means carrying amount is lower than the tax base. This will lead to deferred tax asset. Next, unrealized profit from intra-group transactions, right? So unrealized profit in the sense, the inventory value, I mean, there is unrealized profit in the inventory, means inventory value you must have reduced it. That means carrying amount of asset is down, right? But when my subsidiary sold this, parent sold to subsidiary at a profit, the inventory is in the hands of the subsidiary, then what do you do? inventory minus unrealized profits, you are going to cut it, that you will present in the consolidated financial statements. But for income tax department, in the hands of the subsidiary, right, 100 minus 10 rupees you collect deducted, 90 rupees you presented in the consolidated financial statements. But for the income tax act purpose, 100 only will be considered. That means carrying amount is lower than the tax base. It's going to lead to deferred tax asset. Whenever there is unrealized profit, blind rule, you remember, that is deferred tax asset, it is going to happen. Yeah. And next, deferred tax asset with respect to business losses or unabsorbed depreciation, right? See, if the company has got any business losses and unabsorbed depreciation, that itself is a strong sign that there may not be probable future taxable income. That's the reason, right? Unless until there is a virtual certainty that there will be a taxable profit, otherwise you are not supposed to create deferred tax asset in this regard. Right. And one more important point, deferred tax asset or deferred tax liability, you are supposed to review it at every balance sheet date. Maybe last year you were not having virtual certainty with respect to business losses, you have not created deferred tax asset in the last year, but in the current year we have got virtual certainty. That's why you can create deferred tax asset. As you know, business losses can be carried forward for 8 years. Just 1 year is only over, another 7 years. That means we can offset with the future profits if it is very probable to come in. Right. Next, the investment in subsidiary associate, that is a very small point. You can look at tax rate. Yeah, the tax rate, which rate I should use? Generally, the enacted rate we will take it, but the standard says substantially enacted rate also can be taken. Right. See, this in the balance sheet approach, we will look for always everything in the future. Okay, what will be the future economic benefits will come, future may on settlement of future, everything with respect to future. That's why what will be applicable, the tax rate enacted tax rate applicable for the next year is supposed to be considered, not the current year you are supposed to consider. Okay. Right. If suppose you have got different slabs, but in India for companies there is no slab is applicable. But example, if you have got any slabs like up to particular income, particular rate, under that circumstance, then you are supposed to apply weighted average rate, you are supposed to take it. Next, with respect to deferred tax, no discounting concept. And with respect to deferred tax asset, it is always a non-current asset or non-current liability. Next, deferred tax asset and deferred tax liability, you are supposed to always present it in net if it is arising from the same country act. If it is arising from the same country act, then you are supposed to present it in net. So asset minus liability or liability minus asset, whichever is the higher, the balance number will be presented in the balance sheet. Okay, right. Sir, where should I present the correct asset liability? You spoke are correct, but what about the, suppose if you say deferred tax asset account debit, then what about credit? If you say deferred tax liability will be you are creating, so to DTL you will record. Then what about debit? Yeah, it is always depending upon, okay, it is always depending upon the relevant expenditure, whether where the transaction is getting recognized. If the transaction is getting recognized in the P&L, this deferred tax expense also, expenditure or income should also go to P&L. If the transaction is routed through, say example, revaluation reserve will be routed through OCI. Under that circumstance, this deferred tax income or expense also should be routed through OCI. Right. If the transaction is directly going to equity, like if you remember in case of Ind AS 109, if it is a convertible debenture, that is a embedded derivative concept, directly liability portion derivative part will be directly recognizing under other equity. So directly some income is getting recognized in the equity. Then under that circumstance, deferred tax with respect to that income also should be recognized in the equity only. It should not be transferred to profit and loss. Right. With respect to tax on share based payments, right. See, with respect to tax on share based payments, we always recognize deferred tax asset. I can say straight away. The reason, yeah, 99.9% is deferred tax asset only will come. The reason, right, we will be charging it to profit and loss. We will be recognizing either deferred tax equity or liability as per the Ind AS 102. But what will be allowed as per the Income Tax Act? It will be only what do you say? once it is settled, the actual amount that date settlement intrinsic value only is allowed, but we will be charging it. So you can do some estimation and you can have a look at the sum. That is better to explain it with the help of the sum. Theoretically it is very difficult, right? Offsetting, I told you, there are two conditions, correct? If it is arising, deferred tax asset and deferred tax liability both are arising from the same Indian Act, then yes, that is, then only you can say there is a legal enforceability to offset. At the same time, the company should be having an intention to settle it. Anybody will be intended to settle it in net only. That's it, my dear. This is about Ind AS 12. If you feel this video is useful, please share it with your friends. Thank you and wish you all the very best.